Hello again, Martin Jones here, talking to you about P2. I'm challenging myself to show you how to answer a P2 exam question in 10 easy steps. And really, frankly, as I work my way through this answer to this wonderful question called Kate, June 2010, as I work my way through this answer, I'm going to show you just two techniques. I think that's enough. The two techniques are a top-down method of answering and a heading sentence style of communicating. Top-down just means you communicate the basic knowledge, then you drill down, and then you finally drill down to the actual detail. Okay, let's try part B. I have Kate here on my left-hand side, so I'm going to read it with you and just talk about what we see, and then I'm going to show you the slides for the method that I would use for answering the question. At the 31st of May 2010, Kate held an investment in and had significant influence over Bates, a public limited company. So presumably this entity was an associate. That's at the year end, isn't it? So at the year end, we've got an associate. Kate had carried out an impairment test in respect of its investment in accordance with the procedures prescribed in IAS 36. Now here's the thing, the examiner lies. He lies, he lies, he lies. The truth of the matter is they haven't followed IAS 36 at all. They've done something completely different to what they should have done, and that is what you are going to say. So I just want to read it again. Kate had carried out an impairment test in respect of its investments in accordance with the procedures in IAS 36. And your answer is going to be, no they haven't. They haven't followed IAS 36, and they should follow IAS 36. And that's going to be the basis of your answer. Kate argued that fair value was the only measure applicable in this case, as value in use was not determinable as cash flow estimates had not been produced. In other words, they're going to ignore value in use. They cannot ignore value in use. Recoverable value is the higher of value in use and fair value less cost to sell. And you have to find both. It's not acceptable. Kate stated that there were no plans to dispose of the shareholding. So what? And hence there was no binding sale agreement. Yes, so what? What's that got to do with anything? Kate also stated that the quoted share price was not an appropriate measure when considering the fair value of Kate's significant influence on Bates. Now the examiner's just being deliberately idiotic. He's saying fair value is an inappropriate measure of fair value. Obviously fair value is the best measure of fair value, so you just tell the examiner that point. Market value is the best way of measuring market value. Therefore, Kate had estimated the fair value. Do you follow that? So they have the fair value, but they're choosing to ignore it, and instead they're going to make up their own fair value. So they have the fair value, but they're choosing to ignore it and make up their own. Is that okay? No, if you have the fair value, you must use it. You cannot ignore it. Therefore, Kate estimated the fair value of its interest in Bates through an application of two measurement techniques, one based on earnings multiples and the other based on an option pricing model. I mean, option pricing model, we haven't even got an option. Why the hell are they using an option pricing model? Ridiculous. Neither of these methods supported the existence of an impairment loss. Well, that's convenient, isn't it? So the whole thing has been designed to be creative accounting. See what you think of my answer. I'll bash through it quickly. Here it is. See what you think of my answer. You remember top down, first of all, we just get the basics. So B, impairment. This occurs when the recoverable value of an asset falls below the carrying value. Easy peasy. Recoverable value, definition. It's the higher of VIU and fair value less cost to sell. Fair value less cost to sell is sometimes known as NRV. I just mentioned that in passing. Impairment test. To do the test properly, Kate should have both figures. If Kate really does have significant influence over, if Kate really does have significant influence, then Kate should have no problems getting the VIU information from Bates. It's true, isn't it? I mean, we're saying that we don't have value in use because we don't have the information. But you do, but Kate does have the influence, so they should use it to get the information. Fair value, besides deliberately ignoring the obvious fair value available in the form of the market value, looks very suspicious. It's true, isn't it? Ignoring the fair value when you're measuring fair value looks suspicious, crazy in fact. Conclusion, this looks like creative accounting. It looks like Kate is trying to avoid impairment. Kate should use the market value and get on with the impairment test and do it properly. Now, have you noticed that there's no numbers in the scenario and therefore there's no numbers in this answer? It feels a bit weird, doesn't it? Because we don't actually know if there is an impairment or not. But that's the way that the scenario has been written, so the recommendation is just stop messing around and do the impairment test properly. Okay, that's the way that I would recommend you answer part B.